everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. Thanks for joining me today. Good to have you with me on the show. All right. Today we're talking target date funds. What is a target date fund? Should I invest in one? Should I use it? What the heck? I don't know. What's a target date fund? So this comes up a lot. I like to talk about things on this show that come up in everyday conversations, in real world stuff, in working with my clients, and stuff that comes up for a lot of people when they're kind of trying to navigate retirement planning, 401ks, and often this stuff is confusing. Often people, don't quite know what the terms mean, what the types of funds are, what to choose, what to do. And so target date funds are one of those things that comes up a lot. And so I wanted to take a few minutes and talk about that today and help you kind of understand what a target date fund is and see if it's right for you. So let's start with, what is a target date fund? A target date fund is a mutual fund, which some context here. A mutual fund is a collection of securities. A securities is a stock or a bond. Typically stocks or bonds. There are other things that can be in there, but let's just, for the sake of simplicity, let's just use stocks and bonds. So a mutual fund is a collection of different stocks and or bonds that make up the fund. Typically, a mutual fund will have hundreds of different company stocks in it or bonds in it, and it will kind of diversify the risk and diversify across a lot of different companies inside that mutual fund. So you typically find mutual funds in 401ks and IRAs pretty much everywhere, and there is a type of mutual fund called a target date fund. And a target date fund is pretty popular in 401k plans and 403b plans and company retirement plans. It's also very popular in college funding 529 plans. So you see them a lot in 529s. You also see them a lot in 401ks, 403bs, 457, things like that, things that are company retirement plans. So these target date funds are designed to change the risk across the fund based on your age and the time frame. So here's how they work. So a target date fund takes a date into account. And so when you invest in a target date fund, so right now it's 2021. So let's say you invest in a target date fund that is a 2040 target date fund. As of today, that is 19 years away. So a 2040 target date fund will have a certain allocation between stocks and bonds. And based on the time frame and what year it is as you move toward 2040, that will change. So again, some context here. If you are talking about stocks, we're talking about aggressive investments. The more stocks you have in a mutual fund, the more aggressive it is. The more bonds you have, the more conservative it is. The more the ride's going to be smoother. You're not going to have a lot of volatility or ups and downs. It's going to be pretty conservative. The more aggressive you are, historically, the higher the return tends to be, but you have to kind of balance that with the time frame, because you can have short-term dips in value of the fund because it's all stocks. They can be more volatile. They can go up and down a lot more than bond funds will. So you typically are going to get a higher rate of return with a stock fund if you have the time frame to withstand those ups and downs. With a bond fund, the rate of return tends to be lower, but you also tend to have less variance and less volatility. It's a bit more stable. So that's why we say that if a mutual fund is composed of stocks, then it's going to be more aggressive. It's composed of bonds, then it's going to be more conservative. And as you mix funds together, the ratio of stock funds versus bond funds will determine how aggressive or risky that particular investment is. So a target date fund is typically a fund made up of other mutual funds that are kind of stacked together. And again, it changes along what's called a glide path. So the closer you get to the target date of that target date fund, the more conservative that fund will become. So the idea is, it's kind of a set it and forget it tool where you invest at a certain age, and then the fund just kind of takes care of itself along the way, becoming more conservative as you get closer to retirement, when you are less able to withstand the volatility. So this sounds great in theory, right? This sounds like a pretty reasonable tool and a pretty reasonable approach. So let's unpack it a bit and see what the pros and cons are. So what are some of the upsides or the pros of using a target date fund? One is simplicity. Honestly, it's very simple. You don't have to really worry too much about it. It's pretty much set it and forget it. So if you really just want simplicity, and all you're really doing for investing is this single 401k plan. There's nothing else that's really significant in your financial life that affects it, and you want the simplest way to just kind of set it and forget it, then a target date fund is kind of designed for that. It's designed to just kind of be a one decision at the beginning, and then it just kind of takes care of itself all the way to the end. It kind of keeps you from being too aggressive as you get close to retirement. It manages the rebalancing for you. So the set it and forget it aspect is a bit attractive to some people. It's very hands off. You don't have to do anything. It just automatically changes the allocation to become more conservative as time goes on. So you don't have to do anything with it. It's completely hands off. Also, it has some value potentially if you are on your own, if you're a DIY investor. So if you don't have anyone helping you, if there's no counseling available from your 401k plan provider, or you don't have a financial advisor you're working with, and you don't have the time or the desire to do your own research and kind of learn about all the ins and outs of how to allocate investments, then it might be worth considering to just do a target date fund, because you, again, are kind of DIYing it. You don't have a lot of time to mess with it. You just want to kind of set it and forget it. So the simplicity and the hands-off aspect of it is appealing to some people. That's kind of the advantage. So what are the downsides, though? What are the reasons not to use a target date fund, or reasons to maybe consider not using a target date fund? So the one of the downsides is expense. So I hesitate to bring this up because I don't like getting hung up on expense, because I think so many people get really hung up on the fees associated with mutual funds. And there's a very large, well-known mutual fund company out there that has convinced everyone that all you should care about is fees and getting the lowest possible fee and just investing in the index. And there's something to be said for that. But my opinion is that fees are not the only or even the most important thing when looking at a mutual fund. That being said, if you don't have to pay a high fee, then I don't think you should. And typically target date funds are more expensive because they stack all of the expenses of all those funds together. So you're paying for the expense ratios of each fund and the expense of the actual target date fund itself. So the management comes with a higher fee typically than you could get if you slice these out individually yourself. So not crazy about the fees. Again, fees aren't the most important thing, but again, we want to try to be efficient with fees if possible. Next, it only sees one dimension of your financial life, your age. That's all it sees. So, a target date fund only takes into account your age and the date. It doesn't take into account all the other stuff going on in life. It doesn't see, your risk tolerance. It doesn't take into account other accounts you have, other investments you have. It doesn't take into account changes that may happen along the way. It's very rigid and very formulaic. So it only sees that one dimension when, as people, we have a lot of different dimensions financially in our lives to consider. And especially that risk tolerance factor. So, if you're in a target date fund and your risk tolerance is extremely aggressive, meaning you have an aggressive personality in terms of risk, you feel like you can withstand a lot of volatility. That's the nature of your personality. Then a target date fund is going to pretty quickly become more conservative than is appropriate for your risk tolerance. Vice versa. Let's say right out of the gate, you might have 20 years to invest, but even so, you check your account every day. The news freaks you out. You get really stressed out by dips in your account balance. A target date fund is going to start out more aggressive than might be appropriate for your particular risk tolerance. So that's going to be a factor as well. So the target date fund is really very tunnel vision focused on one thing, and it's not going to take into account the rest of your life. Again, I said this before, but it doesn't count for other investments you may have. You might have, an IRA, a Roth IRA, a taxable account, a healthy balance in all those accounts, and you have a job with a 401k plan than a target date fund. Well, the target date fund doesn't know what other investments you have and what they're invested in, whether they're aggressive, whether they're conservative. It doesn't take them into account. It's just strictly based on a formula. So there may be a better way to allocate your 401k plan as it relates to your other investments. Again, it doesn't adjust with life changes. So if something changes in your life, maybe your retirement date is pushed out further. Maybe it's pushed closer. Maybe you are on track in other areas in your life to retire earlier or become financially independent earlier. The target date fund is not going to be terribly appropriate if things change. Another thing, no ESG options. Typically, I've never seen a target date fund that has ESG or social impact options. And again, ESG stands for environmental, social, and governance. And that is a type of investing where you can choose mutual funds or choose investments that align with certain values that are important to you. Things like supporting environmentally positive practices or social impact in the workplace or in the world, racial justice, things that are important to you. You don't really get ESG or social impact options with a target date fund. It's pretty vanilla. It's pretty much just a vanilla collection of mutual funds that don't really tie to any particular ESG factors or any kind of social impact or environmental impact factors. And then I consider this one of the more important factors is it can limit the growth potential of your investments. So again, a target date fund is really designed to kind of protect you from yourself. It's really designed to make sure that you don't choose the most aggressive option now, and then 20 years later, when you're about to retire, you're still in that aggressive mix because you didn't change it. It's really designed to kind of protect you from that issue of being in unsuitable investments or the wrong type of investments for you when you reach that certain age. So it's designed to be kind of a protective mechanism. However, because of that, it becomes more conservative than a lot of people would want, a little bit more early on than they would want. So as you get closer to financial independence or retirement, whatever term you want to use, it gets pretty conservative. It starts to kind of wind down, get really more bond focused, more bond heavy, and that can really limit your returns, when a lot of people would find it more appropriate to stay more aggressive closer, and then intentionally decide how to reallocate investments as you get closer, but do it with intention, again, based on life changes, based on other factors. And so I've seen a lot of cases where a target date fund will limit the investment potential you have in your investment. So, you might have a difference of even a few percentage points in returns. You might get a better return by managing your investments more intentionally versus just defaulting to that target date fund. So we definitely don't want to run the risk of risking your money too close to retirement, but we don't want to limit your returns either. So investing is this constant balancing act of risk versus reward, and so we want to be intentional with that balancing act. So what's the bottom line? So are target date funds good or bad? Are they right for you or not? I can't tell you if they're good or bad or right for you or not, because like so many things in finance, it's dependent on so many factors and the context of what we're talking about. But I will say this. Personally, I tend to avoid target date funds. I'm not crazy about them for the reasons I mentioned. They can make sense in some situations for some people, but if I'm working with a client, I rarely recommend a target date fund. It might make sense in certain 529 plans. So if your child is getting closer to college age, then it might make sense to flip to a target date fund. So it's kind of gliding into a conservative mix as they enter college to keep it stable. That can make sense. But in general, I tend to avoid them. Now, again, there's not a one size fits all, and there may be cases where they make a lot of sense. But for me personally, I tend to avoid them, assuming that, my client is managing money intentionally with me. We're putting a plan together. If they're my client, that's happening. So that's the default. So, again, as long as you're intentionally managing your money and investing with purpose and intention, then I usually see better options than a target date fund. So it's tempting to kind of click that accept button when the 401k plan at work just offers you target date funds because it seems like the default option. But I would think through if that really makes the most sense for you. So that is kind of the bottom line on target date funds, some of the pros and cons, kind of how to understand them and what they are for. So as always, if you have questions about target date funds or anything at all, please reach out. I always mention this at the end, and I mention this to everybody. I'm very low pressure. If you want to just book a meeting online and chat and ask questions, there's no obligation to work with me. I'm happy to give you feedback and answer questions, and whatever I can do to help, I am happy to do that. So with that, the way you do that is to go to my website, which is elevationfinancial.com. And there's a big friendly button on the homepage, says book a complimentary money session. We can continue the conversation there once you book an appointment online. It is quick and easy peasy. All right, with that, thanks for joining me today. Pleasure having you with me. Have a great day, and we'll see you next time. All right. Thanks everyone who joined on the Facebook Live. Did not see any questions pop in today, but join me anytime you want to on Tuesdays at 1:30 p.m. Eastern. And I do this live via Facebook Live and YouTube Live, and you can always pop questions in as we go. So thanks everyone. Have a great day. See you next time.